Howdy, Jacob here. Today we're looking at Evertec in the financial services industry, 2.3 billion market cap on 2.9 billion enterprise value. Their revenue growth, zero declining years of the last 10 years, with the average of maybe 4 to 6%, and more recently grown more than the mid 2010s of 10 years ago. We see a decline in both gross and operating margin, though, however. So they are making almost double in revenue, but their earnings per share is up not close to double. Their dividends are half of what they were 10 years ago. Not terribly concerned by that, given the amount of their dividend paid in relation to their earnings per share. We'll see what it is from a cash flow standpoint, but also return on invested capital looks fine. I mean, I guess if I do look at operating margin, this 2023 was definitely the odd year, it looks like. I mean, it was fairly consistent from 2014 to 2022. Return on invested capital, upper single, lower double digits. Really not bad. It's the type of industry that doesn't have any research and development. Majority of their expense are going to be the cost of the products that are created to sell their product, and then cash on hand 296 million, short-term debt 24 million, long-term debt 947 million. So I can see an acquisition here in 2023 by goodwill and other intangible assets going up, debt going up. Looks like they used debt to fund this acquisition, and that's exactly what we see here. $423 million acquisition, 470 million issuance of debt. And so if you know me, I like to assume 100% of capital allocation. I don't like to presume people finance their capital ventures through debt. And so, in fact, if they have a lot of debt, I do assume sometimes capital allocation being going to acquitting debt. And so if you look at current capital allocation, well, let's look at current cash flow first. So 130, 140 million in the mid 2010s. Now you're looking at 200 million. So it looks like their free cash flow is definitely going up. Again, it's not almost doubling necessarily like their revenue is. So it hasn't increased as much as revenue, which is something I would have preferred. I mean, obviously, when your company's growing, or they're still in the young growth stage, it makes sense that the revenue is growing a little bit more than earnings since they're reinvesting so much. But for companies that have been around a little bit longer, you do like to see companies being more efficient. And so if revenue's up 100%, maybe net income and free cash flow are up 150%. Those are the type of businesses that I would be looking at, saying that they're a really good business, becoming more efficient, making more off of less, essentially. Their use of capital allocation is mostly acquisitions. They do have some reinvestments of intangibles. They do have some share repurchases, and then the dividend pays out well under 10% of their total free cash flow. So definitely not concerned with this dividend whatsoever. And they are really using all forms of capital allocation that I can see. So that's enough to get me to make some assumptions here on the revenue growth side. They've done pretty well. Okay, so they're in the transaction processing business, headquartered in San Juan, Puerto Rico. I mean, some of these are going into debt to fund acquisitions. And so again, me assuming 100% capital allocation, I'm probably going to stick with 5% revenue growth. And then they do have some debt. We did see 947 million long-term debt in relation to making a little over 200 million. So it's about 5 years of their their free cash flow, a little bit less, 4 to 5 years of their free cash flow to pay off that long-term debt. And so, and short-term debt's pretty much nothing. But I don't know if they need to pay it off, since again, if the free cash flow doubles, that ratio turns into 2 to 2.5. And so I might not assume much capital goes to debt reduction, but I will be assuming that acquisitions is going to be part of this 5%. They haven't been extremely efficient with their um, acquisitions in from a profit perspective, meaning that their acquisitions haven't made them more money with less. And so I feel fairly comfortable going along the lines of a 25-30% margin here, with share change 1% for them is about 23 million. To offset this stock-based compensation, that would make 1% 50 to 60 million, which is going to be about 25% payout, maybe a little bit, 20 to 25% payout. I think I'm fine with that. With a terminal PE and free cash flow of probably pretty much market average here. I don't see why not. Dividend, yeah, they haven't increased it the last couple of years, so I'm fine with that. So based on my current assumptions, it looks pretty close to a price that would make a lot of sense. And so this will likely be a company that I try to do more research on, do an in-depth analysis on in not too long. Hope you enjoy the video and have a great rest of your day.